Section 6. Debt finance is another source of long-term capital for companies. For 6 months, 6 marks, discuss any 3 types of debt instruments that are available to companies. Discuss any 3 types of debt finance available to companies. Who can answer that? We did this yesterday. Those that were here, please quickly answer. Discuss any 3 types of debt finance available to companies. Brian?
I may pass for now.
Okay.
Is a bond one of them?
Yes, the bond is one of them. We discussed this, please, especially those that were here yesterday. Discuss any, actually, any 6 sources of debt finance. We also maybe go to the other type, equity. Okay, let me explain.
Is a lease?
Yes, try.
A lease?
Yes, it's one of them. So we have
A grant?
okay. So we have number 1, bank loans. Bank loans are the most traditional and popular form of debt financing. And these ones are usually available in different sizes. We have short-term, intermediate, and long-term, depending on the borrower. We also have corporate bonds. These are debt securities issued both by government and corporations, which investors use to do what? To raise debt capital. Okay. We also have debentures. What are debentures? Is a long-term debt instrument as well. We also discuss convertible debt. This is a debt which comes in form of financing that starts like a debt and has an option in future to convert it into equity so that you become a shareholder. So investors typically will receive a fixed interest rate, like do ordinary shareholders, and eventually are converted into equity. We also have what is called vendor financing, the type of debt financing which involves an agreement between 2 companies and its vendors. So here the vendors will provide financing to the customers to help them to purchase a vendor's product or services. So vendor financing is also very beneficial for businesses that need to acquire goods and services that they may face cash flow challenges. So these are the common ones. We also talked about what? Debentures. What did I say debentures are? We discussed debentures, that this is a debt instrument which is not secured by any physical assets or collateral, but it represents debt finance between the issuer and the investor. Here, the issuer will agree to pay a fixed interest rate for a specified period of time. Now, we must understand that debentures are typically used by corporations mainly. They use this kind of debt finance to raise capital for various reasons. Number 1, in the event that they want to expand. Number 2, acquisitions and megas. So debentures have a key number of features. They have a fixed interest rate, they have a maturity date, they're transferable, we have secured and unsecured. We also have convertible and non-convertible. So these are the sources of what debt instruments are available to companies. So now, in relation to company sourcing capital, discuss benefits of using equity finance. What are the benefits of using equity finance? Anyone? What is equity? Okay, it's in the interest of time. Equity finance refers to raising funds for a company by selling shares, in short. So the term equity refers to the ownership that shareholders have in a company. So there are a number of benefits that, of course, antagonistic to the owners between shareholders and managers. There are benefits that we would have in having equity. Unlike borrowing, debt finance, you're going to plow back. So equity, basically, we're looking at shareholding. So there's no repayment obligation. When we're talking about equity, people will buy shares, they'll be getting a repayment through dividends. Number two, the advantage of using equity is a shared risk. Here, investors will share the risks. They also share the rewards that come in benefits as dividends. They are what we call capital gains that they will gain as being shareholders, but they may also suffer losses, which a company does not suffer in its independent entity. So they will share the risk. Equity also has flexible payment terms. And since equity does not have a fixed payment terms, the company may be more flexible. So the other advantages of equity is that it attracts talent. So ownership of equity can be used as an incentive to attract or restrain talented employees. So equity will give them a stake in the company's success. The other advantage of using equity is that there is what we call dividend flexibility. Companies here may have flexibility of choosing whether to distribute the dividends to shareholders, or they may want to plow back the retained earnings for company use. Okay, are we together? Can you get me? Can you get me?
Yes, we can.
Okay, today network has been kind of bad. All right, so this is regarding the benefits. So any of these that I've mentioned, you can pick any three benefits of using equity. All right, so we can look at another question. Your wealthy brother is trying to persuade you, your retired uncle, to buy shares in an energy company. He himself owns a few thousands and is impressed by the steady rise in the price. Your uncle is skeptical because Copperbelt Energy pays out very small dividends. Number one, what argument is your cousin likely to make to your uncle? Number two, are the arguments valid in this case? So 13 marks for that. So can somebody come in this scenario? Let's discuss. These are questions that will hammer you in the exam if you don't discuss. Anyone? Please, let's participate.
Sorry, Collins, I was just setting up. I missed the question.
We're looking at the last part here. You may not give me the answer, but just an idea of what the examiner is like. You're looking at part B. Your wealthy industrialist brother is trying to persuade your retired uncle to buy shares in Copperbelt Energy. He himself owns a few thousands and is impressed by the steady rise in the price. Your uncle is skeptical because Copperbelt Energy pays out very small dividend. Part A. What arguments is your cousin likely to make to your uncle? Are these arguments valid? So what is the examiner trying to talk about in here? Let's analyze this question very carefully on sources of finance. This is chapter 1. Chapter 1 is very dangerous if you don't handle it properly. Most of the students skip this. Okay. Anyone to come in before I come in? Brian, you want to try?
Yes, just the contribution.
She can
Mr.
go.
Collins,
She can go first.
okay, by the way, I understood the notes in lecture 1. Before you make any investment, you first of all have to assess, like in this situation, the brother need to assess the performance of the Copperbelt Energy Limited, performance of the business, looking at the cash flow, and maybe looking at also, how can I put it? Like, if whether the shares were kind of constant, because if you look at the rate of shares, it will also determine whether you'll be getting good dividends out of the investment or not, and also looking at the profitability of the company would help him to know whether it's actually viable for him to invest in that business or not. I think so far that's my contribution. Thank you.
Great. Thank you for that. All right, so anyone else to add before I come in? Okay, so your cousin, who's a wealthy industrialist, has to create a case for the retired uncle. Now, here are some of the structured arguments, if I were you, that I would write to say, number 1, he must look at 6 key things. Number 1, potential for price appreciation. So from investing in this energy company, he should analyze whether there could be a substantial price appreciation over a long period, because sometimes these appreciations could be affected by a few temporal issues. So there is need to look at potential price appreciation, not for now, but for later. Then also resilience in the economic conditions. So growth for stocks, especially in the energy sector, Copperbelt Energy, tend to be less sensitive to economic fluctuations. So this will provide a level of stability in uncertain market conditions. So you also need to look at what we call long-term sustainability. So if the uncle were to invest in this company, are there any intentions of this company to reinvest their capital, their retained earnings, to ensuring that the businesses continue to run for a long-term growth? And also issues of risk profile. He will need to give a good argument, because as growth of stocks undergo rigorous scrutiny, they need to be approved and marked. And generally, This is one of the key aspects that must be looked in. And also past proven performance. Well, some of the companies do well in the interim because they haven't been in industry for a long time. So you must also give a proven historical performance of Copperbelt Energy to serve as evidence that this company has a success story. Then also you must argue out the flexible exit strategy. So while it is important to attract investment in stock buying, there should be an exit strategy that investors should have should there be unsatisfactory returns. So he must be able to be assured that should you not be happy, you would still sell your shares and get back some of the monies. And also you must argue out in terms of the bull market performance to say growth of stocks, which include the Copperbelt Energy Limited, tend to perform well in bull markets, which would lead to significant gains for investors like the ANCO. Now, the second part is asking, are the arguments valid? So number one, the status of your uncle being a retired individual suggests that he may not be active in his old age. So you must give him valid facts to say growth of stocks might not be a suitable investment option for him if he's one person who wants quick money. Instead, he could benefit more from a stable generating income, such as investing in assets or dividend stocks or bonds that will provide regular income without him running up and down in his old age. That could be an argument that you'd give. Secondly, looking at risk tolerance associated with retired individuals. So a shift towards investments that offer stability and consistent cash flow, such as stocks, might be appropriate for him than volatile stocks that change rapidly. So especially for him, his old age, we need to secure his investment in less volatile stocks. So these arguments that would be given in favor of the uncle with regards to the energy company could be valid in the context of investing. However, you must advise him that he must consider the uncle's profile as an investor. What type of an investor is he? Is he a risk tolerant, risk seeker, risk averse? Because these are also key in him undertaking such an investment. So these are how we could, I think, scramble your 25 marks. All right. So we also looked at issues to do with what is corporate governance, discuss the meaning, the importance of managing corporations, 10 marks. What is corporate governance? And what is the importance of managing corporations? Anyone?
Let me try. Mr. Collins.
Yes, try.
So the way I understand is the way I understand corporate governance. It's how you manage the relationship between the shareholders, the managers, and the other external stakeholders of the business. That's what I know.
Okay, great. Anyone else? Anyone else? What is corporate? What is corporate governance, and what is its importance in managing corporate its importance in managing corporate corporations? That's 10 marks. Okay, so yeah, the way she has answered it, you get 7 marks. So when you're dealing with corporate governance, basically, we are dealing with a system of rules, practices, and processes by which a company is directly controlled and directed. So corporate governance actually encompasses the relationships amongst stakeholders. It provides a structure through which the objectives of a company are set. So this means that it aligns the objectives of a company, monitoring the performance based on the objectives set. So that is briefly how we can define what corporate governance is. Okay, let me just add a quick write-up. Those of you who okay, so corporate governance refers to what? A system of rules and practices, processes by which a company is directed and controlled. It encompasses various relationships among stakeholders and provides a structure through which objectives of the company are set and the means of attaining these very objectives. Now, the second part of the question was asking us, how is corporate governance important in managing organizations? Okay, so corporate governance is important for so many reasons. I can set out 13 or 10, so I'll just give you 5 or so. So those are the pamphlet, you can access all this in there. So number 1, protection of stakeholders' interests. So corporate governance will ensure that the interests of various stakeholders, including shareholders, employees, customers, and the community are protected in a balanced manner and effectively. So how does it protect the interests of the community? Ensuring that social corporate responsibility is done. Corporate governance also ensures that there's transparent decision-making. So good corporate governance will promote transparency in decision-making processes. It also ensures that decisions are made in the best interest of, number 1, the company, number 2, the stakeholders, who include the shareholders. Corporate governance also ensures accountability and responsibility. It establishes clear lines of accountability and also responsibilities within the organization. It ensures that individuals in positions of authority are accountable for their actions and decisions. Corporate governance also looks at the aspect of management of risk. So corporate governance will help to identify, it also help to mitigate risks that could affect the organization, thereby enhancing the company's resilience to internal and external challenges. So you can mention a number of them. I'll leave them at that. So I want you to fortify on the mark allocation. Last semester, like I said, the exam was mainly theoretical. All right, so corporate governance also enhances what? Performance and efficiency. It also helps regulate compliance, ensure that there's compliance. It also ensures that there's a reputation management where it promotes the transparency and ethical behavior. Now let's go to a few calculations in stock valuation. Stock valuation. Now, to start with, stock valuation is mainly a key topic that looks at how we can value our stock now. So we have 2 models that are very common. We have what we call Gordon's model, what we call constant growth model, when we're dealing with stock valuation. Basically, these two models are based on time value of money. So suppose, let me look at basic examples before I go to a complex one. So suppose we are told that dividend has been declared now of 10 kwacha at a growth rate of 8%. Okay, calculate D1, D2, and D3 using the constant growth model. Who remembers how can we calculate the D1, D2, D3? So this is just future value of money in terms of the dividend or stock valuation. So we're starting with 10 kwacha. The growth rate is what? The growth rate is 8%. So I taught you in my previous class how to quickly calculate the growth. You don't want to use these long cuts. And this is what I'll use to look at a quick example from the exam. So you start with 10. If it's 8%, just multiply by 1 plus R. So this is what? 1.08. So you multiply 1.08 throughout. So the next one, 10 times 1.08, what we get? 10 times 1.08, we get what? 10.8. So the 10 kwacha will be 10.8 in year 1. Again, this 10.8 in year 2, just multiply by 1.08. It will be what? 11.66. This 11.66 in year 3, just multiply by 1.08. What do we get? 12.60. These are the growth. All together, this is easy to remember. All right, now the exam will come as follows. So say suppose you have just declared a 10 kwacha for the
Sorry, sir.
Yes, please.
On this one, aren't you not supposed to raise the interest to the raised to t?
It's the same thing. I was saying that's a shortcut. So if you want to calculate the growth for year 1, is D0, 1 plus growth to the power time. Time is the difference in years, is the power 1. If you want to calculate the growth in year 2, is D0, 1 plus growth to the power 2. If you want to calculate the growth for year 3, it is D0, 1 plus growth to the power, difference in years, 3. You can also calculate the growth in year 4 against year 3 by calculating 1 plus growth to the power 1, because the difference in years is 4 minus 3 is 1. So this, if you were to calculate it, 10, 1.1, 1.08 to the power 1. For year 1, you're going to get 10.8. For year 2, you're going to get 10 times 1.08 to the power 2. You're going to get 11.
Collins, I can't see what you're doing really.
Can you see my screen?
I can see your screen and it's static, so I can't see anything else.
Is it the same with the rest?
We
are
can
seeing-
see
Could be
we start.
network.
All right. Okay, maybe it's my network. Can I restart the link? Then I'll send it to you so that we can look at stock valuation.
Not your network. Not your network. It's his network. We are able to see all of it.
Is everyone else able to see?
Yes, we can see. I think you just need to log
Yes.
out and log.
Okay.
All right, that's fine.